Why are institutional investors pouring billions into franchise platform plays? What do they know about recurring revenue models that individual franchise investors are completely missing? I'm Justin Kaiser, co-founder and CEO of EmpireFranchising. And after 24 years of building, scaling, and investing in franchise platforms, I scaled a brand from 0 to 100 franchise units and sold it. And I want to tell you the brutal truth about where real value is created in franchising, because most people are still chasing the wrong end of the stick. The opening question for any serious investor is this: do you want linear cash flow or asymmetric equity upside? Owning 1 or 5 franchise units gives you predictable cash flow if things go well, but it caps your upside and it traps you in operational risk. Owning or partnering with a platform that takes equity in multiple franchise brands multiplies leverage. It diversifies risk and it compounds value. And that's the difference between buying a job and buying an asset that appreciates. I'm going to be direct. Most franchise buyers are sold on a story about independence and immediate cash flows. True investors run option-style models. They price the downside, they model the cadence of cash flow, and they map the path to enterprise value. Platforms change the geometry of that model because they own equity. They also control distribution of capital and technology, and it standardizes the operating leverage across brands. That's why at Empire Franchising, we acquire 40% equity in every brand we bring into our ecosystem. Not because we want control, but because it creates a portfolio of equity assets that scale faster and sell for higher multiples than a single unit stream ever could. So let's talk through the math and mechanics so you can understand why this matters. A single unit's EBITDA might be attractive on paper, but it's fully correlated to local market risk, manager quality, and lumpy capital expenditures. Multiply that model across dozens or hundreds of units, and the marginal cost of governance, tech, supply chain, and brand management explodes for independent owners. A platform, on the other hand, internalizes those costs. It spreads them across many brands, drives down marginal cost per unit, and converts what used to be fixed overhead into scalable infrastructure. The result is higher system-wide margins, faster rollout velocity, and valuation multiples that reflect enterprise strategic value rather than localized cash yields. When professional capital values companies, they don't value cash flow alone. They value growth optionality, defensibility, and repeatable unit economics. Franchise platforms that provide standardized training, unified technology stacks, centralized vendor contracts, and disciplined growth playbooks create defensibility and repeatability. And that's where multiples bend upward. We don't buy unproven ideas. We partner with founder-led concepts that have proven unit economics and cultural fit in the local market, then provide the growth capital and operational muscle to scale them faster and cleaner than they could alone. That alignment is why good founders choose platform partnerships over selling outright or raising traditional growth capital that dilutes focus. So let me be clear about exit mechanics, because this is where the ROI case crystallizes. Platform-owned franchise portfolios can exit through strategic M&A to larger multi-brand operators, private equity buyouts that pay for scale and recurring revenue, or even IPOs when category dynamics and scale justifies public multiples. Those exits command enterprise valuations, often 8x to 15x EBITDA for consolidated tech-enabled platform models versus 3x to 6x that might be applied to standalone chains or lump sum location portfolios. When you own equity across multiple brands with technology and recurring fees layered on the top, the exit arbitrage is real. Now, let's cover the practical investment terms in our offer. We're now raising a $3 million seed round for 20% of Empire Franchising, because that capital accelerates our ability to acquire and integrate high-quality franchise concepts into the platform, to invest in core technology that unlocks margins, and to scale our centralized services team that multiplies founder productivity. At this valuation, we're offering investors an opportunity to buy into platform-level upside at an early multiple with projected capital efficiency that outperforms single-unit investments. If you want a place in a repeatable, founder-friendly, tech-enabled franchise platform that takes meaningful equity to align incentives and accelerate value creation, then consider our seed round. We're deploying capital into our product and team to create a diversified enterprise that compounds value across brands. Visit EmpireFranchising.com to review our deck, request the unit-level models, and schedule a direct conversation. We want the right investors on board who understand platform economics, appreciate founder alignment, and think long-term about equity upside. Subscribe to our channel to track integration and case studies, portfolios, KPIs, and roll out playbooks as we scale. This is where serious investors move from passive franchise ideas to owning the platforms that will define the next decade of franchising and build the next franchise empires.